Hi everybody, welcome to our DAT IQ Weekly Market Update. This is our update for the 1st of July, episode 345. Hard to believe we're halfway through the year already. I'm Dean Croke, market analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy. Chad, how is it today? Back from vacation?
Yeah, things are good. I kind of get my stride back together. But yeah, I'm kind of jealous. I think while I was out, you did a road trip, hit about 3,000 miles over the road, you were saying?
Yeah, it was just it was a week's vacation. Luckily no ELD device. I'm ELD exempt, so I was able to get it knocked out pretty quickly. I went out to Madison, Wisconsin, to the American Truck Historical Society show, where you can see the history of like the last 100 years of trucking. But more important, you get to see all the trucks that were on the road that kind of made that pre-deregulation, post-deregulation era.
Mm-hmm.
And some of the highlights were some of the trucks from the famous movies. Convoy truck was there, BJ and the Bear, Smokey and the Bandit, like the original trucks used in the movies.
Oh, cool.
Were there on display. It was really cool to see them and meet some of the owners that have restored those trucks.
Oh, that's neat.
There's a whole world in trucking that's around preserving history, and just fascinating to see chain-driven Max trucks, pre-emission trucks, pre-EPA rule trucks, triple-digit trucks. For those that don't know, ones that can run triple-digit speed, like the real deal.
Nice. Yeah. Is that downhill or flat?
Oh no, on the flat.
Yeah?
On the flat.
Right.
You could. You would have seen them if you're out on the interstates in the 80s and 90s. Spread axle reefers and hauling produce cross country, like they were iconic. A lot of those trucks.
That's great. Glad you got back safely.
Yeah, it was kind of amazing the way car drivers drive, though. Like my new dash cam has caught some amazing footage that I've yet to download and publish, but it's kind of unbelievable.
Maybe we should bring that into this show, bloopers that you see out on the road.
Yeah, exactly. Yeah, normally you'd say only in America, but the reality is it's like everywhere now. Car drivers just seem totally disconnected from what's going on around them. I don't know whether it's the design of vehicles. I do know that big LED-style televisions in the middle of the dash don't help. Right. Because I see people staring at those a lot. But then, Chad, so do truckers. Truckers are watching their screens, other than out the windscreen, a lot too. So I don't fault car drivers, completely here in this debate. But
yeah, and a lot of the podcasts that people are watching while they drive have video streaming at the same time now. It's tempting to look over and check that out. Yeah.
Yeah, it's pretty nuts. I'm old school. I like to drive a truck. I don't want to steer it. I want to drive it.
Yeah.
All right. No guest today. So, Chad, we've got a good discussion coming up a little bit later about things like pallet season, contract rates, all sorts of things that are happening, shippers RFP season and what we're seeing. So we'll bring you back in a bit later.
Sounds good.
All right, so let's dive into the market update. Lots we're watching at the moment. Spot rates are going against seasonal trends in the lead up to July 4. This is a short week. So normally being July 4th week, it means typically a spike in dry van and reefer spot rates. Not so this year. The market is really floundering. It's lacking direction and momentum. Produce volumes, excluding citrus, so that's the caveat here. Citrus volumes will come in once the June reporting is done by the USDA, but excluding citrus, produce volume still down 8% year over year. More alarmingly, they're down 16% year over year in California and down 38% in Florida. They're kind of meaningful statistics. They're the big produce growing regions. A couple of data points I looked at. Fresno is the biggest produce market in California in the Central Valley. Typically sees a rate spike leading up to July 4. This year, it's 32 cents a mile lower than even the last 2 years. So this year is very different for a lot of reasons. Year to date, national produce volumes down 3 to 4%. California, though, down 22%, translated into truckload volume. That means year to date, we've seen almost 26,000 fewer truckloads of fruit and veg. Big markets like Salinas, which is the home, or it's what's called the summer salad bowl, home to strawberry and lettuce production, usually produces about 50% of weekly truckload volume out of California. Spot rates down 2 cents last week, again, going against trend. Normally rates are going up 20 cents a mile lower than this time last year. At 217, almost the lowest in a decade. even 7 cents a mile lower than during the freight recession in 2019. So not good news. We've been saying for quite a few weeks that it looks like produce season won't deliver this year. That is playing out. I think there'll be some tightening in capacity this week, though. It's a short work week. There will be some volatility in some lanes for sure. Big news we're watching this week, of course, is when the EIA push out their weekly ULSD numbers. That's the number that most fuel surcharges are calculated from. In the last couple of weeks, we've seen diesel prices surge 30 cents a gallon over concerns of a military conflict between Iran and Israel, and the closure potentially of the Strait of Hormuz. That's eased somewhat. That market has cooled down, although we're still watching it very closely. I don't know that a ceasefire is that certain just yet. That could change any minute. So that'll be out later today. We'll be able to report on that during the week or next week. Currently, diesel's sitting at about 378, almost the same as it was a year ago. Bob Costello pushed out the ATA tonnage index for May. Used the word choppy. The freight market remains choppy. Specifically, truck freight tonnage was down 0.1% after gaining 0.5% in April, so essentially flat, but down about 1.3% from the same month last year. That's the ATA's for-hire seasonally adjusted truck tonnage index. Don't forget the long-form version of today's report will be out this evening at dat.com/market update. All right, let's dive into the market update, starting off with our load posts in the dry van market. Surged by 16% last week, but they mirror the typical week 26 trend we've observed in the pre-July 4 period back over the last decade. So no real surprise there. A lot of freight was being positioned in end markets last week. Carry equipment posts down, a little bit higher demand on some lanes. Load to truck ratio ended at 6.78. In the refrigerated market, again, exactly what we'd expect. Load post volume surged last week due to last minute rush in produce shipments, up 35%. That's load post volumes for reefers up 35%. The increase in load volume coupled with a drop in equipment postings led to a 3% increase in the load to truck ratio, ended at 13.41. And in flatbed, volumes were largely consistent last week, not a lot of change, but about 13% higher than this time last year. Equipment post down by 8%, load to truck ratio in flatbed held steady around 25.70. Having a look at our year-over-year spot rates, you can see on the charts there I've removed the pandemic years, and I'm just showing you years that behaved more normally compared to the pandemic. So they considered, or certainly I considered them more outliers, 2020, 21 and 22. Looking at the chart there, you can see that average line haul rates, they were down 2 cents per mile last week to $1.65. That's about 4 cents a mile lower than last year and about 2 cents a mile higher than during the 2019 freight recession. On our top 50 lanes, based on volume, rates averaged $1.98. That was down a penny per mile. This is about 33 cents a mile higher than the 7-day rolling average for all lanes. And in the key 13 Midwest states, which accounted for 45% of load volume last week, that's loads moved, they often foreshadow national trends. Spot rates were down a penny per mile also. Outbound load volume in the region also fell, down by 4%. The average rate per mile in the bellwether states in the Midwest was $1.84, 19 cents a mile higher than the 7-day rolling average. Having a look at the reefer market, reefer spot rates held steady last week, defying expectations by remaining flat at just over $1.95. That's about 8 cents a mile lower than last year and only 2 cents a mile higher than during 2019's freight recessionary period. Looking ahead to the short work week this week, we anticipate a last-minute surge in produce volume. So this, combined with the holiday, is likely to cause some rate volatility and tighter capacity in key markets, particularly California and Florida, as well as imports from Mexico via the McAllen market in the Rio Grande Valley. All right, wrapping up with flatbed. For the second consecutive week, the national average flatbed spot rate, excluding fuel, declined by 2 cents per mile, settling at just under $2.12. Despite the drop, the current rate remains 7 cents a mile higher than the corresponding week last year, but that gap is closing. We'll get back closer to normal year-over-year comps very shortly as rates head south towards the end of August. All right, short-term forecasts. Let's have a look at our short-term ratecast forecast going out 35 days. That's the green line. That's predicting what rate view will be 35 days from today. It heavily weights longer-term seasonal trends, and it's bounded by the yellow and red bands. They're the upper and forward-looking band. So this is line haul only, excluding fuel for loads moved over 550 miles. In Dryand, Ratecast is expecting rates down 3 cents a mile out to August 2nd, averaging $1.62 per mile. That'll be about 1 cent per mile lower than where they were last year. The low case in red has rates down 7 out to the start of August. High case has rates up 1. In the refrigerated market, rates down 3 cents a mile out to August 2nd at $1.94. That'll be almost identical to where they were this time last year also. The low case in red has rates down 8, high case up 2. And in flatbed, Ratecast is expecting rates down 5 cents a mile out to the 2nd of August, averaging 206. That will be about 8 cents per mile higher than where they were last year. Low case has rates down 10, high case has rates essentially flat. So I think Ratecast has been pretty accurate over the last month. If you've been following the show, Ratecast has certainly been very accurate in predicting where rates will go, considering all of the somewhat choppy demand that we're seeing in the market as shippers are sort of essentially frozen in place with the trade war and lack of certainty around trade policy. All right, Chad, over to you for a quick look at the contract freight market.
Thanks, Dean. And as a reminder, everything Dean covers is from a broker to carrier spot perspective. So I'll cover from a shipper to broker and carrier contract and that relationship with spot rates that shippers are procuring. So the first metric here in yellow, the spot premium ratio, this goes back to 2016. It's a weekly metric. And you can see that we're at negative 10%. That means that spot rates are 10% lower than contract rates right now. And you can see that recent seasonal pattern over the last couple of years since we've been in this soft market cycle. The new rate differential in blue here measures new rates compared to the rates they replace. These are contract rates. So this answers the question, what are shippers' RFPs or bids yielding for contract rates? We're at positive 1.1%. You can see we've been bouncing around the positive territory and zero for many months now. And then the contract rate index there in purple, that's measuring 80% of the rates in routing guides right now that are contract. And you can see a very slight gradual slope up and to the right. But you can see this looks like an equilibrium market across the board here from a shipper perspective in the contract space. On the reefer rates, you can see spot rates, spot premium ratio at negative 9.8%, just about 10% below. And then that new rate differential at positive 0.4, just barely positive there. And then contract rate index, pretty much flat. As a matter of fact, I looked at the year over year, still right at 0% change year over year for the quarter Q2, rounding out Q2 here this week. And then moving into flatbed, this is a monthly metric. We try to report this out about once a month. So the month of May came back at negative 4.5% on spot premium ratio. New rate differential at negative 2.6 has not made it above that positive or into the positive territory yet in this cycle. Contract rate index just bouncing around there. We've got a lot more spot activity in short-term lane rates in flatbed. It's kind of a different animal than van and reefer. And then the next slide here is just showing the rate per mile relationship for those three equipment types: dry van on the top, temp control, and flatbed. And then finally, to wrap things up, we've got intermodal by month here at a positive 1.2% rate increase on the new rate differential, and that contract rate index still pretty flat, bouncing around a little bit. Intermodal follows closely behind on dry van. There's a bit of a lag there in intermodal. That's a wrap on contract rates, Dean.
Looking at your charts there, both dry van and reefer have been fairly flat, moving sideways. It kind of fits a lot of the economic narrative we've been hearing, particularly from Chairman Powell from the Fed right down to some of our own internal analytics. But is this sort of unusual as you see rates at the halfway mark of the year? Normally, I would have thought we'd see more upward movement. Certainly in the past, when you look at your charts, you see this fairly observable inflection between a soft market to a hard market. But we're not seeing that right now. So what's your take on how you see the market at the halfway mark, and what do you think the rest of the year might look like?
Yeah, it's really surprising. I think back to last fall when we were at DATCon and our shipper summit and talking to customers about when we expected to see the market turn. Right. We just had a rate cut. We were thinking that Q1 would start to lift up a little bit, and then the real tell sign would be how Q2 performed, and I think it's definitely on the soft side. I know, thinking back to my years working for a pallet company, every March we were just geared up, getting ready for produce season. We had a lot of pallets going into the fields on flatbeds, and we needed short-term capacity, so we were preparing for that. And it was probably one of the most stressful times of the year. I suspect it hasn't been so stressful this year, with produce season one being softer and capacity being more available than usual. We are seeing that flat and to the right trend on Dryand. I did look it up just before the show here. We are at a 1.5% Q2 inflation read here. So that's Q2 this year versus Q2 last year. But it's just it's a very steady, slow, gradual contract rate increase, which is interesting. So these are these long-term contract rates that we're seeing from some of the larger shippers. So they're still giving out rate awards that are year-over-year increases, slightly so, where it makes sense to get good service and secure drop capacity. But in that spot market, it's just really soft. But they're limited in how much freight they can move in that spot market.
Correct. Yeah. I always like how your distinction is, and I think we lose this in the discussions, that contract freight really reflects in the main drop and hook, whereas the spot market is more live, load, unload, and the split is like 80-20. Like you've just described 80% of the market, which is mostly drop and hook. Whereas we talk about the spot market, which is mostly live load. Very different markets when it comes to
it can be a broad brush generalization, but for the most part, contract is drop trailer, working with asset-based carriers. Brokers have moved into this space a little bit more over the last few years. And I know, 10, 15 years ago when I was working with a shipper, we were not getting much drop capacity from brokers, but that has changed a little bit over the years. But for the most part, it's short haul, it's regular route, it's drop trailer, asset-based carriers. That's where they really want to devote their capacity. If they can't get it on dedicated, that's their first priority, right? Get a sure thing, get sure revenue tied up around those assets. And if you can't get that, then it's that one-way contract rate. That's the next best thing. And then spot's the last thing that a large asset-based carrier wants to handle.
Yeah, that's been a feature of the recent earnings calls, certainly Q1, even Q4 last year, was how much the large TLs are growing their dedicated percentage. I think that's the space they want to continue. Although I did notice in some of the recent earnings calls, they were expecting some churn in that area because of lower one-way for higher costs. Maybe that's sort of something we'll see in the next round of earnings calls. Yeah,
we do see some slight mix change there, where when it's really soft, our shippers will move a little bit more freight. We're talking single-digit percentage points from contract into spot. But they are limited by that. It's really hard to move a drop trailer on spot. So they're limited by that equipment requirement.
Right. So talk a little bit about, dynamic pricing, API carriers, things like that. How does that play into a drop trailer scenario? Because I'm assuming in that scenario, if you're looking for an API carrier, you're looking for a truck and trailer to move a load.
Yeah, the API connections, the shippers that I talk to that use those for spot. So it's just a more efficient way to procure spot, a faster way where you don't have someone watching their a shipper's transportation management system load board and monitoring bids and making awards. They'll blast out an API call to 5 brokers and get that bid back immediately, make an award. You can also, some of them will put our DAT rate in there as a threshold. It needs to be within a certain percentage point of that DAT rate. So it really drives efficiency on the shipper side and the broker side if they can get the numbers right and get it to work. But it's really hard to move drop trailer freight in that space too. So normally that's reserved for live unloads as well.
Yeah, I was looking at some data over the weekend. A lot of people have been talking about, and I think incorrectly, about how unsafe the industry is in quoting out of service rates. And the problem with the out of service data is it doesn't tell you whether it's the truck or the trailer. And I know from personal experience that drop trailers have a far different on-road characteristic. They degrade faster because they're not loved. A lot of drivers will pull under a trailer and just take off, even if there's something wrong. I've been guilty of that in the past, last century. But what happens is when you need probable cause to pull a truck over, the trailer's the first thing a lot of people see. And the problem by saying that, the industry has a 22% out of service rate for brakes or whatever, you don't really know whether it's the truck or the trailer.
Oh, interesting. Yeah.
Quick survey over the weekend on social media, it's more like 90% of the time it's the trailer.
Oh, wow.
That's the problem. And that kind of fits with, if you've worked in trailer pools, they tend to be pretty badly kept, especially the ones that sit at the back that don't get used very much. So I remember working at a trailer GPS company, and we saw a lot of trailers that never got used and some that were overused. Like there was never this even rotation like you would with groceries on a supermarket shelf.
Yeah, that makes sense. It's easy to call a truck and tell them you need to swing through the shop, but when it comes to the trailer, somebody has to go find the trailer, bring the trailer in, and it might not always fit into the efficiency of the operation. But yeah.
So when you talk to me about a shipper, what does your shipper look for? Like they go to the spot market, is it purely price, or is it how much does service come into this, or how much does the equipment factor into it?
Yeah, well, it's always going to depend on the shipper. They're going to be all over the board, but I think for the most part, the ones that I talk to, some of the larger shippers, are service first focused. So they've got those criteria, and that's really the gateway of who can enter their spot load network, right? A private network within their TMS system. So they'll gate which brokers can come into that, and then communicate clearly with those broker partnerships about their requirements of service. Make sure that they're going to get a high level of service. And then from an equipment standpoint, those equipment standards are pretty much vetted out already in the contract process. So it's not normally done on the fly. It's done ahead of time. Yeah.
Right. For carriers interested that might be watching about thinking about how do they get into contract freight or finding a good balance between spot and contract, when is the best time to be talking to shippers about this?
Yeah, so we see a lot of bids start the process, the bid data preparation process in the fall, and then they'll start to get those bids out to market around late fall, early winter, and then they'll start to execute on those early winter to late winter. So somewhere around late fall or early winter is probably a good time to start talking to your shippers. Hey, do you have any bids coming out? Most shippers the larger ones will hold an annual RFP, and that's the typical schedule. But they vary. There's some that have a summer bid, large annual RFP. Some do different equipment types and stagger them throughout the year, things like that. And then even outside of that annual cycle, they'll typically have mini bids as well. So that's new customers come online, or inventory is changed upstream in the supply chain. So they have new lanes they need to service. So keeping that partnership open, talking to them on a regular basis, making sure that they know where you're a fit in their network is really the key. Making sure you've got a contact there that knows where you're going to service them the best.
I remember at DATCon last year, one of the shippers said that, and I'm paraphrasing, but the worst time to bring in new carriers is during the bid process. The best time, of course, is before the bid process. So you've got some history. What's your view on that?
Yeah, I know Kevin Zwire talks a bit about that as well. I think we've had him on the show and he's mentioned that. I think it's a good strategy, and I know that's one I've deployed as well. As we used to have a strategy to bring on so many new carriers throughout the year, and a lot of times some of those smaller carriers bring the best service and some of the best cost if they're in the niche market for you. So we would try to target onboarding some of those, being respectful of our broker partnerships, making sure that they weren't always already working through them. So we would do that throughout the year. And one common strategy is to bring them in and let them maybe help out in the spot market. Other shippers see that as that's something you don't want to do because that's some of the more difficult freight. But we kind of had the viewpoint that if they can prove themselves in the spot market, give them one load, see how they do, see how service is, and they can prove themselves there, then we could trust them with some contract freight and then graduate into that contract bid scenario.
Yeah, this is fascinating. Do you normally see an event that kind of triggers the market inflection? And I guess what I'm leading to is we don't really see anything on the horizon that's good news in terms of demand. Is there, in your time in the industry, both on the asset side and where we are now, is there always something that triggers the market?
Seems to be in general demand driven, with some supply constraints usually coming at the same time. And I can think back to, like, those years where we've had 3 hurricanes in a row at the same time that we've had some regulatory change that's kind of tipped things over. I think speed limiters are off the table now, I think I heard. So that's not something that's going to restrict supply. I hope we don't have a big hurricane season, especially living in Florida. I don't want to have to prepare and clean up for that. And I hope everybody stays safe. So, we'll see. It's a wait and see. There's black swan events out there hanging around that could, make the demand start to pick up a little bit. If the Fed starts to reduce rates, this fall, that could help for sure.
I was looking at the charts this morning, and of course the light blue chart on all of my charts is 2018. And of course that started in 2017 in September with 3 Cat 5 hurricanes leading into, that was a recovery year, strong industrial economy. 2018 we had changes in the tax code, rally, oil price rally, and it was really a big flatbed year all the way through to about July. And then of course we had tariffs come in May of 2018, and that trade war with China started. And then we had the freight recession in 2019. So even 2018 rates look really high compared to every other year. So, and so I remember back in 2018 we said, this date is an outlier, you'll have to scrub it. Of course, then we had the pandemic, and it made 2018 look fairly normal. But even looking at within the last 10 years, excluding the pandemic, 2018 looked like an amazing year for carriers.
Right. And I remember that. I remember that well. One of those hurricanes put a limb through my roof. And it was also the year that I left working for a shipper and came over to the technology side. So it was a lot of fun to kind of watch the metrics move up and to the right. I didn't have to deal with the pain of it.
This is, I did a piece for I was the source of an article with Wall Street Journal last week with Liz Young. And I said carriers were hoping for a recovery this year. Instead, we got a trade war. And I think this wasn't what people were expecting. The problem is we've still got an oversupplied market. We were coming out of a freight recession. To your point about ships still having pricing power, even with changes in supply, and we're not seeing carriers exit the industry at a higher rate than before. Even year over year, like they're still relatively stable. So there's not a lot of change on the supply side, and there's just nothing on the demand side that might be a catalyst for more loads on the back of trucks. If anything, fewer, because we're seeing fewer in produce. We're seeing fewer single family homes being built. Doesn't matter what data point you look at, we're just seeing less and less of things getting made or purchased that might end up on the back of a truck. And of course, today's ISM PMI, when it comes out, which will be after the show, that'll be very telling, especially the new orders index. We'll be anxiously seeing what direction manufacturing goes in.
Will that be a read for last month or last quarter?
It'll be this month. It'll be for the month of June.
The month of June. Okay. That'll be interesting.
Within the first 3 days, Zach Rogers' LMI comes out, the Logistics Managers Index. We're looking at the inflection between capacity and prices on the transportation side. But again, I expect that we're going to see a repeat of the same.
Well, if our rates are a leading indicator, it's not going to look good.
Exactly. We're not seeing the sort of impact of produce season that would normally suggest there's an inflection point this month. That's certainly not happening. All right. That kind of brings us to the end of the show. A couple of shout outs. Thanks, Chad. Don't forget, ACT Research Market Vital Seminar, August 20 to 21 is on. The grand opening of Radio Nemo's new studio in the Degar House in New Orleans is on 7/23, July 23. You can catch Road Gang Radio every day at 7 a.m. Central on iHeart, YouTube, and Facebook. Chris Kaplis has the podcast out called Freight Vine. He's talking to Mike Hicks from Ball State University. Really good listen. You want to talk about the impact of tariffs on the freight market? He's got some really good insights. Next week, we have Chris Orban, a good friend, long-term work colleague. He's talking about recent developments in the small fleet TMS space. He's the architect of the Journey TMS system for small carriers. Don't forget, the CBSA 7-day brake safety week has been announced. Another Operation Airbrake campaign scheduled for August 24 to 30. That's August 24 to 30. Make sure you put that in your calendars. Also, make sure you set up alerts for our shows, subscribe to our channel on YouTube. With that, another show is in the books. Thanks for watching. Be safe, be nice to everyone, and we'll see you back here again next week at 10 a.m. Eastern, 7 a.m. Pacific.